This is David Ranson. Welcome to our webcast for the month of May 2020, the topic of which is the apparent disconnect between capital markets and the real economy. I'd like to show you some slides which will illustrate the view that there is no disconnect. We expect a vigorous recovery, not only in stock prices, but also national output, followed by long-lasting social upheaval. When hit with a natural disaster, a free market system is adaptive. It changes its shape to minimize economic damage, and it can emerge quickly with undiminished vitality. The response of the public sector is defensive. It avoids popular discontent and seeks to keep intact its powers and infrastructure by any means necessary, even to the extent of shutting down private enterprise. The most important result is a grave widening of the performance gap between national output and the labour force, a sustained jump in inequality. The widespread impression that pessimism is high and rising is probably the result of the way that the news media have portrayed the crisis, repeatedly emphasizing bad news at the expense of good. Exhibit 1 shows that the financial markets are sending the opposite message. As of mid-May, the US stock market, always the most visible indicator of fear or euphoria, has recaptured something like 70% of the ground that it lost since its March the 4th peak. 3 other financial market indicators of fear include the prices of gold and long treasury bonds and the level of the VIX index of implied volatility. In the chart, these 3 indicators are standardized and combined into a composite fear index. This index and the stock market both suggest that fear has subsided to its level at the end of February. As might be expected, the day-to-day correlation between the S&P and the fear index is inverse. But this chart suggests something else over the longer haul. The fear index anticipated the turnaround in the stock market a couple of weeks beforehand. Exhibit 2 compares the rebound trajectories of the S&P with indexes of B and C grade junk bonds. As has been true in the past, junk bond prices are slower to come back than those of equities. But what the 3 trajectories all have in common is the way they fit a curve. The speed of rebound is highest following the turning point and then declines exponentially. Investment performance is on a track to produce a net positive return for 2020 as a whole. Under normal conditions, government bonds serve as an indicator of expected inflation. In a crisis, as an investment safe haven, they are also an indicator of financial market fear, and they are also distorted by extreme monetary policy. Exhibit 3 shows that the pandemic interrupted an upward trend in government bond yields around the world following the bottoms they reached last August. New bottoms were reached in most countries, most dramatically the United States. But even in the face of new QE efforts across the world, bond yields are on the rise again. We expect them to return to pre-pandemic levels within a few weeks or months. With recovery in US financial markets well underway, the jury is still out on the US economy. Worst-case scenarios early in the pandemic quickly led to widespread forecasts of a recession in the US. But this new jump in pessimism was counter-historical. Exhibit 4 shows no concordance in the timing of pandemics and recessions since World War II. They are independent events. Even the flu pandemic of 1918, in which millions died, wasn't accompanied by an economic setback. In the current case, a recession is resulting from unprecedented moves to shut economies down. If a recession is to result from a pandemic, it must be self-inflicted, as events are demonstrating. Exhibit 5 explains why a pandemic does not automatically lead to a sustained drop in output. The essential insight is that an economy is not a lump of clay, but behaves like a living system that adapts to its surroundings and to constraints imposed on it. If circumstances prohibit the production of one thing, a substitute will be produced instead. Examples of adaptation include the boosting of output when a shutdown is anticipated, and boosting it again after the shutdown ends. This is routine experience for a local natural disaster. Economic interruptions can involve the destruction of a lot of human and physical capital, a major flood for example, but others, such as a major snowstorm, may not. Those which leave the stock of capital undamaged are followed by a return to the prior level of output. The current pandemic is an example of a natural disaster which is unusual in scale, but it leaves the stock of capital virtually unscathed. A vigorous rebound in national output is not intuitive for many people, but specific historical episodes confirm this profile of an economic interruption. One iconic example is the 1970 General Motors strike, illustrated in the left panel of Exhibit 6. Real GDP was already on the rebound from a recession at the beginning of the year, but it suffered a deep and temporary setback during the strike. The rebound from the strike was more than strong enough to return GDP to its prior trend. Another, more dramatic example occurred in the UK in 1974 during the energy crisis. A mandatory 3-day work week forced a partial shutdown of the economy. In this case, the underlying trend in output was downward. Still, real GDP returned quite quickly to its former path after the constraints were lifted. History tells us that unemployment will not decline quickly, even with a strong rebound in total output. That's because it's less urgent for recovering businesses to rehire lower productivity workers. And unemployment compensation for them is a disincentive to seek work urgently. Even when benefits end, many lower paid workers simply drop out of the labour force. Total employment will be weak for a decade or more, as Exhibit 7 shows happened after 2008. And household spending, together with many related aspects of the economy, will therefore grow slowly as well. There will be a big swing from consumption to saving. The profound implications for inequality and social upheaval are obvious. Different economies differ in their resilience to a crisis like this. The most resilient economies should be expected to be associated with the strongest market recoveries. Exhibit 8 confirms that these tend to be economies with the freest markets. The chart makes it clear that the rebound in equity prices has been far from uniform across countries. Among this sample of countries, the winner to date has not been the United States, but Switzerland. Japan did not take as big a hit as the US, but has been left behind on the rebound side. The worst performer is the UK, followed by Germany, whose rebounds are slower. The tactical asset allocation opportunities normally relate to cyclical fluctuations in inflation or growth over a 1 to 2 year time frame. We use leading indicators for anticipating the performance of major asset classes, as shown in Exhibit 9. The price of gold is plotted horizontally and credit spreads vertically. But events during a crisis move with more speed than usual. The dramatic upsurge in the BAA-AAA ratio shown in the chart is already subsiding rapidly. This means that the time horizon of forecasts based on spreads has shortened considerably. Normally, such a large change in the BAA-AAA ratio would mean a decline in GDP 6 to 12 months out. In this case, it signals an immediate GDP decline, which of course is already upon us. If the BAA-AAA ratio continues to fall, the outlook for growth later this year and next would not be greatly hurt. Another complication during a crisis is safe haven seeking. Capital flowing out of risky assets pushes up the gold price, even if inflation pressures are absent. To corroborate the current gold price signal, we have to look at other leading indicators of inflation, such as the Consumer Price Index for goods and the Producer Price Index for commodities. On this occasion, these leading inflation indicators do not corroborate the gold price. So, following the bullet points on the broad situation in which we find ourselves, I'd like to introduce Frank Kane, an old friend and colleague, former co-worker of mine, and who will ask some questions to which I've composed some responses. Please go ahead, Frank.
David, U.S. equity markets have shrugged off an awful lot of bad news during the last few weeks, at least up until this last week. What's the rationale for that?
The impression that a lot of the news has been bad is partly due to the way the news media have played the coronavirus story. There's a well-known tendency to give more publicity to bad news because it attracts a bigger audience than good news. From the beginning, worst-case scenarios received the most weight. Perspective has been lost. Hard new information about the severity and future of the virus threat is scarce, and basic facts are still a matter of scientific dispute. On the whole, the news from new scientific investigation has been good. The virus seems to have spread far earlier and more widely than was initially thought. Several major universities have made fatality rate estimates that are orders of magnitude lower than the worst-case scenarios that justified the shutdowns. In any case, the stock market is pricing investor fear as well as information. By any measure, fears have been abating since early in March, and much of the market's rebound is due to that.
Is the equity market expressing sentiment about the future of the equity market or the future of the economy?
Both. The future of the equity market and the future of the economy are intimately related.
I seem to remember some evidence that the stock market is a leading rather than coincident indicator of economic activity. Wouldn't that explain the apparent disconnect between the current crashing of the economy and the strength of the equity markets?
Yes, the stock market discounts the future performance of the economy rather than the present or past. The fact that national output is greatly depressed at this moment has little weight in the calculation. There is no reason to assume a mysterious disconnect. Present stock prices are expressing market expectations that output will rebound after the shutdowns lift, and the market responds more to information that is a surprise than to information that is anticipated. The US economic shutdown was not a surprise. But a rapid rebound in output does not mean that unemployment will come down quickly. A rerun of the aftermath of 2008-09 is more likely. It's easy to forget that the labour force is far from uniform. Productivity varies from individual to individual and is far higher in the upper tail of the frequency distribution than in the lower tail. When shutdowns end, it's those in the upper tail who are immediately rehired. National output is able to rebound quickly to pre-crisis levels because, for a time, the upper tail can carry the rest of the economy on its back.
Okay, if that's so, why isn't the market pricing prolonged levels of high unemployment?
The stock market discounts total output and corporate profitability. Unemployment, which reflects the unevenness with which economic activity is spread among the population, is not its central concern. But as financial viability and confidence return over time, companies become willing and able to reabsorb more and more of the labour force.
If unemployment takes a long time to come down, surely that bodes ill for the economy. Consumer spending has been a mainstay of the growth we saw in the last couple of years, not capital investments, not exports. How do you think a consumer-based economy can get back to normal if unemployment remains high?
I don't see the US as having permanently changed its structure to a consumer-based economy. The mix of goods and services produced from the capital available is a choice that will change with circumstances. The pre-crisis economy tilted toward consumer goods and services rather than domestic investment. The post-crisis economy will be free, indeed obligated, to choose a different production mix. For years to come, the crisis has changed the mix in two basic respects. One is the ability of some industries to produce relative to others. And second is the demand environment, what the economy most needs or wants. On the supply side, industries like travel or food and entertainment away from home were prospering before the crisis, but they will come out of it compromised financially and hampered by efforts to protect against future viruses. Capital will flow away toward industries that have been less damaged. On the demand side, consumer goods and services were emphasized when the economy was in a comfortable Goldilocks equilibrium with decent growth and a fully employed population. Now that a large part of the labor force is unemployed or discouraged, we should expect a swing away from consumption and towards saving.
Looking ahead, how far into the future is the equity market expressing optimism? Is the market's horizon a month, 6 months, a year?
There is no single time horizon, but on the average, stock market movements precede changes in real GDP by about 6 months.
Amazingly, the bond markets seem to have shrugged off their own share of bad news, at least by historical standards. What's the implicit message when the U.S. Treasury can issue trillions of dollars of new debt, with maturities as long as 20 years at the kinds of rates we're seeing today? Or, said differently, what do investors in long-dated T-bonds have to believe in order to lend for 20 years at less than 1.5% per year?
Well, first, government bond yields are distorted by central bank purchases. They do not reflect reality, and that's why they are already beginning to rise again. At the same time, indebted as it is, the US government enjoys very strong creditworthiness. That's partly because there is little competition from other economies around the world. The largest free market capitalist economy in the world is capable of generating enormous tax revenue, and the assets owned by Washington, which include 2/3 of the country's land area, dwarf those of the great majority of other governments.
Are the bond markets betting that we're headed into a deflationary environment? Or does the current pricing of T-bonds simply reflect demand for a safe haven? And if so, why isn't gold benefiting from that? Gold prices seem to have stalled lately.
In the United States, there's little sign of either inflation or deflation. The dip in commodity prices reflects partly the weakness of the shutdown economy and partly the absence of inflationary pressure. The price of gold is greatly elevated because, like T-bonds, it is a safe and liquid haven for anxious investors. As the safe haven effect diminishes over time, both gold and T-bond prices are likely to decline.
Finally, what do we need to watch out for over the next 6 months? What are the so-called canaries in the coal mines these days?
Financially, yield spreads between the highest and lowest quality investment-grade corporate bonds are still a canary in the coal mine. They have not yet returned to normal. Biologically, another is Sweden. If all goes well there, it might eventually demonstrate that economic shutdowns were a mistake. Well, that completes our Q&A section, and thank you very much, Frank, for very good questions. I'd like to move on now to briefly mention some topics for future publications. We're certainly not done with the coronavirus yet. So here are some tentative titles for publications coming up in the next month or two. The Dark Side of a V-Shaped Recovery. That'll be published under the heading of Economic and Investment Observations. Foreign Markets, When to Buy and When to Sell. That'll be an International Forecaster report. And the Economic and Stock Market Effects of Environmental Cooling and Warming. That'll be an Equity Market Outlook. I'd like to thank you for listening to this webcast and look forward to the next webcast in 2 months from now. Thank you.